back to Primary Source China Investment. This week we're on show F4, and we wanted to talk a little bit about the China tech stocks, those China tech stocks that are listed in the US, Hong Kong, and those stocks that are listed on the mainland. Because while the performance overall for most of them has been very bad, there's been some volatility on the upside for US and Hong Kong names, but not so much for the China listed ones. So we're going to get into it a little bit. The sentiment has definitely changed, and some of the biggest names in Hong Kong that we're talking about, Tencent, Alibaba, Meituan, are up something like 50% in a month. They're down about 30% year to date, but there's something happening, and it's not happening on the mainland. Recall the names that are traded in these big ETFs, MCHI and KWEB. We talked about them a lot. They trade Hong Kong and US listed Chinese stocks. Those two ETFs, MCHI and KWEB, share 6 of the 10 top names. And those names are down year to date 35, 28, and 25% respectively. You can see on the chart the clear reversal at the end of October. So you can see they were down upwards of 60%, some of those names, particularly Tencent was down. And now, they've rebounded a lot. Still down year to date, but rebounded a lot. Peng.guo, any thoughts about those specific names that are Hong Kong, US listed?
I think, if the audience track our show, probably they will know I keep saying, so we should watch the bottom. But the problem is the bottom has, in our understanding, it's not a 1 day or 1 week. It's really like the period. While the tech stock getting down, firstly, is that the fundamental value get disappeared or not disappear. So if not get disappeared, that really means the opportunity. I think recently, especially in October, so technically it's reached the bottom. And from the government policy, it also reached the bottom. And also from the valuation point and the market emotion, that's all the bottom. So 3 bottom, add them together, they will be bounced back. So the only problem is this stocks get high volatility. So people just cannot hold it.
But that's we're going to get into a little bit of the trading psychology of that. But I wanted to talk also about the mainland stocks. So
yeah, mainland stocks is the same thing. So mainland stock is really constricted by the COVID. So right now is internet is in the mainland. It seems like get a mature market, and also the growth market is really in the overseas, especially in the South Asia area. And also in the mainland, that also called hard tech. So hard tech looks like meet the China's long-term government policies support. So and also they have a strong market demand. But all those things, just keep in mind, it's still related to the energy related, new energy related, clean energy, technology, upstream, downstream. And that is all the things.
That's policy driven. So some of these the biggest tech names on the mainland. Remember, mainland traded A shares, ZTE stock symbol 000063. That's down 25%. Hangzhou Hikvision 002415 down 38%. Luxshare 002475 down 37%, and CATL down 33%. Now, some of our viewers are familiar with these names, but if you're not, these are the largest China listed tech names. And if you look at the chart, they've just been drifting downward for the entire year. Some of them may look like they've hit a bottom. Some of them have looked like they've rebounded. But in general, they have not seen the lift from the names in the US and Hong Kong. And one of the reasons is volume. If you look at the volume for Tencent, Alibaba, Meituan, all saw and are continuing to see volume increases, significant volume increases since late October. Hikvision, Luxshare saw volume decreases. And interestingly, CATL had a huge sell-off from August to November, but volume remained stable. This is one indication that retail, or perhaps perhaps the Reddit crowd is getting into the bidding. Historically, the mainland was the domain of all of these retail traders. Remember, you say, oh, China's market is 80% retail. But now we're seeing, the US with these meme stocks, it does look like a lot of these names are being bid up because they're much easier to buy for US investors. We're seeing a huge volume come into the US and Hong Kong names and not a huge amount of volume from the China mainland names. So I'm asking, do you think that maybe the run up is not just a bottoming effect, but a lot of retail traders jumping into the Hong Kong and US listed names?
In my understanding, the bigger volume at the bottom mostly came from the institutional client. Retail investors, they cannot buy confidently at that time. And it's only the institutional client, they will get involved, they can buy it and buy it quickly. I think especially for the Hong Kong and overseas China stocks, the reason is because the lot of fund, if they allocate it to those areas, if meet their policy for any reason, they have to buy it. Otherwise, if the index get bounced back, you cannot keep up with the index. That means you cannot beat the index.
Well, that's the old saying, buy on rumor, sell on news. I don't know, for our viewers, it's more, who are more buy and hold. You're saying that opportunistically you saw these three bottoms, and hey, if we have these three bottoms, it's probably more upside than downside. So some institutions are probably stepping up at that point.
That's right, and very quick. And also, that's a lot of the money came from China. So, and also due to the Shanghai, Shenzhen, and Hong Kong connected, they also have the ETF related to that.
Yeah.
So like the China's buying power, they can also push into the Hong Kong market. Even though one day, they could trigger very big volume, because it's more like the news-driven, what they call the event strategy to doing that.
Yeah, if you look at MCHI and you look at KWeb, although they're big in terms of ETF, this is 5 billion, big demand or big inflows can affect the price to NAV. So it could get bid up just because of more demand than supply of the ETF or creation of units. It's an interesting dynamic that's happening where A-share stocks are still flattish, didn't see this big uptick, and the US and Hong Kong stocks have seen a big uptick in the last 6 weeks or so.
That's right. Yeah. I think I finally understand why the active manager cannot beat the index, because they get a huge volatility. So most of the time they cannot tolerate such kind of the volatility in their portfolio. But from index perspective, as long as you see this is the bottom, yeah, just hold it. You don't care. One day it might jump like the tech, Hong Kong tech sector. It might one day as market open jump 5-6%, or maybe next day it's a drop like the 7%. It's quite normal. But from portfolio, you cannot suffer the volatility.
Yeah, that's the active manager portfolio's dilemma. The reward of being right is not as great as the penalty for being wrong, because things sell off faster than they jump.
That's exactly right. Yeah.
Well, we're going to leave it there for show F4. Thanks for tuning in, and we'll see you next week.
Thank you.